WTI's two-week rally seems to have ended, yet that remains to be seen. Currently, we tend to focus on the situation of the US oil market and also keep an eye out on China, as well as the international supply side of the oil market. In this report, we aim to shed some light on the catalyst driving WTI's price, assess its future outlook, and conclude with a technical analysis. We note last week's comment about the problems in the supply side of the US oil market given the freezing weather. Yet Baker Hughes reported an increase in the number of active oil rigs by 2, implying a small rebound on the production side of the US oil market and a pickup of demand. API, on the other hand, reported a wider than expected drawdown in US oil inventories, yet API's data were contradicted one day later as EIA reported an increase of oil inventories, implying a slight slack in the US oil market. The big picture seems to be shifting, as in the week before we had a rather solid picture of a tight US oil market, yet now the signals we get are rather mixed. It seems that the US oil production sector is slowly restarting its engines, and should the widening of the US oil reserves reflect the increase of production, we may see it having an adverse effect on oil prices. On the demand side, we noted in the last report the stimulus package prepared by the Chinese government, yet note that the January PMI indicators for the manufacturing sector continue to be discouraging. It's characteristic that the NBS manufacturing PMI figure increased slightly, yet remained below the reading of 50, implying another contradiction of economic activity for the past month. On the other hand, the Caixin manufacturing PMI figure edged lower, yet remained above the cutoff point of 50, implying a slight increase in economic activity for the sector. Once again, we interpret the mixed signals sent by the indicators as sign that the Chinese factories are still struggling to increase economic activity and thus placing doubt on substantial increase in oil demand, which in turn may weigh on oil prices. On the supply side of the international oil market, we note that OPEC's oil output in January registered the widest monthly drop in 6 months according to Reuters. Understandably, the largest decline stemmed from Libya's given the social unrest that forced the shutdown of a major oil field in the country. Normally, we would expect Libyan production to rebound in the coming month, which in turn may widen the supply side of oil and thus weigh on its prices. Yet OPEC may have the final say, as in a meeting today, the organization is discussing the implementation of its planned production cuts. For the time being, the organization is not expected to alter its production plans, and given that the already announced production plans have been priced in by the market, we may see the result weighing on oil's price. As the commodities price was aiming for the 79.65 resistance line, the bull seems to have gotten cold feet and the price action rolled down yesterday near the $75 support line. An interesting element is that the WTI's price rolled down, it broke the upwards trend line guiding it for the past 2 weeks, signaling an interruption of the upwards movement. Hence, we switch our bullish outlook in favor of a sideways movement bias initially. We also note that the RSI indicator remained close but above the reading of 50, which highlights the fading of the bullish sentiment in the market. Yet for the bullish outlook to re-emerge, we would require the price action of WTI to reach a higher level than the last peak, thus to practically break the 79.65 resistance line and thus opening the gates for the 84.3 resistance nest. On the flip side, should the bears take over, we may see WTI's price breaking the 75 support line, taking aim at the 71 support base. And that's a wrap on today's financial highlights. Stay in the know and we will catch you next time right here at IronFX.